For years, people have been told that the safest place for their money is a bank. Work hard, save diligently, and trust the institution to handle the rest. That was the promise. But the reality looks very different once you examine it closely. Banks do not work for you. They work for themselves. The mechanism is straightforward. Every dollar you deposit is immediately put to use, lent out to other customers who pay the bank interest. The bank profits from your money, while returning to you only a minimal interest rate on your savings. The imbalance is not accidental. It is by design. So if the traditional model of saving pennies in a savings account is not building wealth, what is the alternative? The answer is to stop being a passive saver and become an active investor. The word investor tends to intimidate people. It sounds like something reserved for financial professionals or the ultra-wealthy. But investing, at its core, is simply putting your money into assets or ventures that have the potential to grow and generate a return over time. It is about making deliberate, strategic choices that multiply your wealth, not gambling, not recklessness, but informed decision-making aligned with your financial goals and personal risk tolerance. One accessible entry point is the stock market. When you buy shares in a company, you become a partial owner of that business. If the company performs well, the value of your shares increases, and you benefit from that appreciation. Bonds offer a different path, essentially lending money to governments or corporations and earning interest in return. But the investment landscape extends far beyond stocks and bonds. Real estate, mutual funds, exchange-traded funds, and even building your own business are all legitimate avenues for growing wealth. The principle that ties them all together is diversification, spreading your investments across different asset classes to balance risk and opportunity. Yes, investing carries risk. That is undeniable. But consider the alternative. Money sitting in a savings account is not safe, it is stagnant. It's the financial equivalent of burying cash in a jar in your backyard. Technically secure. Practically useless. What separates wealth builders from everyone else is their willingness to let money work on their behalf, leveraging the power of compounding, generating passive income, and accumulating wealth over the long term. You do not need a fortune to begin. Low-cost index funds, automatic investment plans, and consistent contributions over time, these are the tools available to anyone willing to start. The key is not perfection. The key is to begin and to remain consistent. Now let us address something even more fundamental, something that makes many people uncomfortable: debt and taxes. Debt has a terrible reputation among ordinary working people. It is associated with burden, stress, and financial ruin. And for good reason. Mismanaged debt can destroy financial lives. But that is only one side of the story. The wealthy understand something about debt that most people are never taught. Used correctly, debt is not a liability. It is a tool. The conventional wisdom passed down through schools and families sounds sensible on the surface: work hard, save money, get out of debt, and never return to it. But this is not how wealth is actually built. In all of recorded financial history, there is virtually no example of someone becoming genuinely rich purely through saving. Saving preserves money. It does not multiply it. What the wealthy do instead is use other people's money. They tap into credit systems, borrow strategically, and deploy borrowed capital to generate returns that far exceed the cost of the loan. The rich do not risk their own money when they can risk someone else's. It sounds counterintuitive, but look at how the world's most successful corporations operate. Consider companies like Hilton, Apple, or Amazon. When any of these giants decides to open a new hotel, construct a warehouse, or expand operations, they do not simply write a check from their reserves, even when they have more than enough to cover the cost. They borrow. Why? Because risking borrowed capital while preserving personal wealth is a fundamentally different financial strategy than spending your own resources. The poor ask, why take on bank debt when I can pay for it myself? The rich ask, why risk my own money when someone else's is available? But the strategy goes deeper than that. There is a dimension of this that almost no one discusses openly: the relationship between debt and taxes. The wealthy do not interact with the tax system the way most working people do. Rather than declaring large amounts of taxable income, they structure their financial lives around debt and capital gains. In practical terms, this means they conduct business not with their own money, but with borrowed funds, and borrowed money is not taxable income. Take Jeff Bezos as an example. One of the wealthiest human beings on the planet, and yet, by multiple analyses, he pays a lower effective tax rate than a middle-class worker. How is that possible? The answer lies in tax codes, legal structures, and a sophisticated understanding of how to minimize taxable income by utilizing debt as a financial instrument and focusing on capital gains rather than traditional salary income. This is not tax evasion. It is tax optimization, operating entirely within the law, using rules that were written precisely to allow this kind of financial architecture. Understanding this system does not mean embracing recklessness or lawbreaking. It means recognizing that debt and taxes are not threats to be avoided, they are mechanisms to be understood. The goal is to use them wisely, strategically, and within the bounds of the law to create pathways to wealth that the conventional save and hope approach will never open. Now, beyond the mechanics of money, investments, debt, taxes, there is a dimension of wealth building that is less quantifiable but equally important: the ability to solve problems. Problem solving is, in many ways, the most underrated financial skill. It is not about running calculations or making impulsive decisions under pressure. It is about developing a strategic mindset, a way of approaching obstacles that transforms them from dead ends into opportunities. The wealthy do not get paralyzed by financial challenges. They do not panic when things go wrong. Instead, they treat problems as information, signals pointing towards something that needs attention, analysis, and a solution. Every problem, in their view, has an answer. The question is simply whether you have the patience and clarity to find it. Central to this approach is a proactive mindset. Rather than waiting for crises to arrive, wealthy individuals anticipate them. They stay informed, conduct ongoing research, consult experts in relevant fields, and position themselves ahead of potential disruptions. When a problem does emerge despite their preparation, they do not react emotionally. They step back, assess the full scope of the situation, and break it into smaller, more manageable components. Large, overwhelming problems become a series of smaller, solvable ones. Another critical element is seeking outside perspectives. The wealthy understand that their own viewpoint is inherently limited. No single person sees the full picture. By actively engaging with people who bring different experiences, expertise, and angles of vision, they gain access to solutions and strategies that might never have emerged from internal deliberation alone. Diverse perspectives are not a luxury, they are a competitive advantage. To develop this capacity in your own financial life, begin by reframing your relationship with obstacles. A financial problem is not a sign of failure. It is a challenge with a solution waiting to be discovered. Cultivate the habit of staying informed about economic and financial trends, build relationships with knowledgeable mentors and advisors, and when difficulties arise, resist the urge to react immediately. Break the problem down. Approach it systematically. Seek input from others. This mindset, applied consistently, is one of the most powerful engines of long-term financial progress. Alongside problem solving, there is another asset that many people overlook entirely when thinking about wealth: reputation. In the financial world, your reputation functions as a form of currency. It is the foundation of trust, and trust is what makes financial relationships, opportunities, and deals possible. A strong financial reputation signals to others that you are reliable, responsible, and competent. It opens doors. It attracts partners, investors, and institutions willing to extend credit on favorable terms. Your reputation directly affects your access to capital. When banks and lenders evaluate a loan application, they are not simply reviewing numbers. They are assessing your track record, your history of honoring financial commitments, managing credit responsibly, and demonstrating discipline over time. A strong reputation translates into better loan terms, lower interest rates, and greater financial flexibility. A damaged one closes doors and raises costs. Maintaining and developing a strong financial reputation requires consistent action. Monitor your credit history regularly by obtaining reports from established credit bureaus. Review these reports carefully for inaccuracies, unauthorized accounts, or signs of fraudulent activity. If errors are found, address them promptly and directly with the relevant bureaus and creditors. Beyond monitoring, build good financial habits into your daily life. Pay bills on time. Manage debts responsibly. Keep your credit utilization ratio low. These are not dramatic gestures, they are small, consistent behaviors that compound over time into a reputation of trustworthiness and financial discipline. Cultivate relationships with reputable financial professionals, advisors, accountants, lawyers, who have demonstrated records of integrity and expertise. Their guidance enhances your decision-making. Their professional endorsement strengthens your standing. And never underestimate the power of your broader network. Attend financial seminars and conferences. Engage with professional communities. Surround yourself with people who take their financial reputation seriously. These connections are not just social, they are strategic. All of this brings us to a final principle, one that runs beneath every strategy discussed here like a current. Every decision has a price. This is not a warning. It is a description of reality that the wealthy have internalized completely. They do not make impulsive moves driven by emotion or the appeal of immediate gain. They calculate. They evaluate. They consider consequences before acting. When wealthy individuals borrow money, they do so with full awareness of the repayment terms, the potential return on investment, and the associated risks. When they invest their own capital, they conduct meticulous research, analyzing growth potential, production trends, cost structures, and long-term profitability prospects. Every financial move is preceded by a deliberate process of evaluation. This principle is captured precisely in the book The Psychology of Money. Its message is direct: nothing is free. Every choice carries a cost, a trade-off, a consequence. The wealthy do not resist this reality, they embrace it. They understand that building extraordinary wealth requires extraordinary discipline, and that discipline means willingly choosing long-term benefit over short-term comfort. Picture a fork in the road. One path offers immediate gratification, the purchase, the indulgence, the comfort of now. The other path offers something harder to see, the compounding return, the asset that appreciates, the financial freedom that arrives years down the line. The wealthy consistently choose the second path. Not because they lack desire for the first, but because they understand the math of delayed gratification. This does not mean avoiding all risk. Calculated risk is essential. But the wealthy weigh risk against potential reward with clarity and precision, rather than reacting to opportunity impulsively. They know what they are paying for every decision they make, and they make those decisions deliberately. Applying this principle to your own financial life begins with a simple habit: pause before acting. Whether you are considering a significant purchase, an investment opportunity, or a change in your savings strategy, stop. Evaluate the trade-offs. Ask what this decision costs you, not just financially, but in terms of time, opportunity, and long-term trajectory. Consider whether this choice moves you toward your ultimate goals or away from them. This applies equally to small decisions and large ones. The discipline that prevents an unnecessary luxury purchase and the discipline that drives a well-researched investment decision are the same discipline, practiced at different scales. Building wealth from the ground up is not the product of a single brilliant move. It is the accumulation of consistent, deliberate, well-considered choices made over time. It requires a willingness to challenge what you were taught about money, to see debt and taxes not as enemies but as instruments, to view problems not as roadblocks but as solvable puzzles, and to protect your reputation as you would protect any valuable asset. Every financial decision you make has a price. The question is whether you are paying it consciously, or simply letting it be paid for you. This content is intended for educational purposes only and does not constitute investment advice. Prior to making any investment decisions, it is essential to conduct thorough independent research and consult with qualified financial professionals. The value of investments can rise as well as fall, and past performance is not a reliable indicator of future results. Always evaluate your individual risk tolerance and financial objectives before committing capital.